For more on the road ahead for the insurers, let's bring in David Sampson. He is the American Property Casualty Insurance Association CEO and president. David, thanks so much for joining us. When you hear about this problem, when you're hearing about the losses that have just amounted to just a total that we have not seen in this industry ever, what are the ramifications of this?
Well, I think Contessa pretty well gave you a good assessment of what the ramifications are. Natural disasters have delivered hundreds of billions of dollars in losses every year, insured losses every year for the last 3 years. As a matter of fact, $275 billion in insured losses due to natural disasters over the last 3 years. That's the highest total ever in the United States. The first half of 2023, we've already seen $40 billion in insured losses. And of course, that's going to go up as a result of Maui, as a result of the wildfires and Hurricane Idalia. And we're not even in the peak of the hurricane season yet.
Walk us through what happens, though, to communities where you can't get insurance. Insurance is much harder to get or is much more expensive to get.
Well, obviously, we're in the risk transfer business. The last thing we want to do as an industry is to have to pull out of any marketplace. But the realities are that due to economic inflation, the highest rates in 40 years, combined with other socioeconomic factors like legal system abuse and the global cost of capital, and as Contessa pointed out, the inability in some states to get adequate rate, insurers are faced with the hard decision to rebalance their book of risk as more and more people move to the most natural disaster-prone areas of the country and are building more and more expensive homes in those areas. We have to get an adequate return on our capital to be able to be sustainable to pay those claims when they come in.
Hey, it's Tim. Thanks for joining us. And my question is there some good news in terms of cost of capital and in terms of return on capital from higher interest rates? Insurance companies are also about managing risk and about managing cash flows and liabilities. This is a unique time in history for insurance companies to actually be taking less risk and earning more.
Well, that is certainly a factor and has helped. But when you look at the global capital markets, reinsurance is, of course, a global capital market. Reinsurance rates have increased 57% over the last 2 years. Primary insurers don't keep all of that risk on their own books. They buy insurance from the global reinsurance market. Part of the challenge is that there are, for the global capital markets, there are other vehicles to invest in that offer higher returns than insurance at lower volatility. And so that's a part of some of the challenges that the industry as a whole is facing right now, is attracting capital back into the primary insurance market.